All right, everybody, I'd like to introduce our next presenter here on the top tier track, moderated by Maj Soueidan at geoinvesting.com. I'd like to introduce CreditRiskMonitor, the team. Mike, Jerry, do this. Here you go, Maj.
Thank you, Bobby. Thank you for being here. This is CreditMonitor, CRMZ. So this is a really interesting company here. They help their customers kind of evaluate risk in some parts of the business, and we're going to get into that. And you haven't done one of these ever or in a long time? What's
no, we don't really do much on the IR front. Honestly, we're kind of the opinion that if we get our revenue metrics up, all of you guys will find us on screens anyway. So to be honest with you, we don't really talk very much. But
well, we got a lot of questions then because you haven't been talking for a long time, so you got a bunch coming in. So let's get right into it. So I mean, what do you do? You just launched a new product in this whole suite, so let's talk about that. But when you're doing this, let's talk about the evolution of the product over time. And you're almost 100% SaaS business. High gross margins. And now we're going into a recession environment potentially. So there might be more demand, and that's not the only current that's good for you right now. So we'll talk about that too.
So I think we obviously started in 1999, 1998. So when we first got into the business, we were covering about 300 public businesses. Just for everybody's edification, really the cheat sheet on understanding our business is we compete with Dun & Bradstreet. So similar business, selling into trade credit risk, supply chain risk, counterparty risk, essentially B2B basis. So we've started with a focus on public companies, given that D&B's kind of claim to fame is really more on the payment, trade credit collection of data, essentially how AR is flowing. So they tend to mix AR into all public businesses as well in terms of payments, and we kind of took the position that was possibly concerning, considering public companies can access capital markets, and therefore they can really continue to operate right up into the point of filing in terms of making timely payments, because CFOs don't really want to send that signal out. It'll screw up their inventory, screw up their runway, all of that. So that's really where we started. We've obviously evolved since then. We're now covering about 57,000 public companies worldwide with our Frisk analytic, another 325,000 private companies in European markets. We've got about 330,000 North American private companies covered with our PACE analytic, and overall we're covering about 30 million businesses worldwide with some variety of both predictive analytics and descriptive summaries through payment information. We collect about just under 3 trillion or so in terms of AR transaction data ourselves currently, and that's really kind of the lifeblood of some of our private company analytics. As Maj, you were saying, we just recently launched Supply Chain Monitor, which is a platform that's really more driven towards that review of your vendors for their own financial stability. Our position is you can spend a lot of time assessing them for ESG, assessing them for capacity, assessing them for a variety of other things. But at the end of the day, if they aren't financially stable, you're just setting yourself up for a time bomb in your supply chain. So we like to think about that as kind of the first check that you have to get through to make sure that you're only working with companies that are sustainable. We think about that really more so from the financial space. So that's kind of where we are. Originally when we launched the product, we kind of got into that market because we were selling about 25% of our revenue already into the procurement use case on the credit risk platform, which was designed for trade credit. So we knew there was a market for that service, and we spent about 3 years kind of working with our current clientele, designing out a platform that's more specific to that use case. So we launched that back in May of 2022, and it's in its go-to-market phases right now.
You were doing this before COVID came along, if the supply chain issues came along.
I would love to say that we're the smartest guys in the room and we knew that was coming when we decided to get into this, but no, this was just a situation where you got to be opportunistic through optionality. So we try to keep all of our options open and then take what the market gives us.
So this allows you to go deeper into the risk of a particular company to assessing it. You talked about Dun & Bradstreet. So are there other companies also doing a similar type of supply chain risk management assessment?
Yeah, I think, as far as the public space is concerned, probably DMB is the best quote unquote index that you could use. But there's a variety of other folks that are in it, whether you're looking at, Credit Safe, Rapid Ratings, Moody's. Yeah, Moody's obviously bought up Cotera, which was in that space before, BVD, so there's some, but a lot of them have been rolled up now into larger businesses. So when you're really looking for a public comp, I'd say probably DMB is your basis.
So, I mean, when you talk about the data, you're processing all this data, getting all this data. I mean, are you all going after the same information? Is it as easy accessibly for you as it is for Dun & Bradstreet? And so is there a secret sauce here that makes you guys better than the comps?
I think the data space is, very wide ranging because it's obviously, as you get more and more into trying to make predictions on private businesses, the data gets very thin. So you're trying to find interesting little pockets everywhere. Some of it's obviously publicly available. I would say the biggest differential for us in terms of data gets down to the trade credit space. So obviously DMB has been doing this for, 186 years or whatever. So they have an enormous file, in terms of trade credit. As I mentioned, we're collecting just under $3 trillion now annually in terms of our own trade receivable program. The biggest difference there is that we spend a lot of time cleaning up that data and getting it kind of massaged into viable, usable space. I think the biggest difference when you look at our trade versus what you see out of DMB or some of the other competitors I mentioned, a lot of them go out and buy trade. And the problem with buying trade is that you often end up with double counting issues because it's very hard to trace who's the actual owner of the AR in that situation. You're really getting reporting on the AP side of it. And so what ends up happening is that you can end up in situations where you're actually putting out signals that are really not usable, in my opinion. They're almost double counted, so they end up kind of telling you summaries that are maybe not necessarily correct. So we've spent a lot of time also not producing signals on businesses where we have very thin file. We don't think we're doing a public service to our clientele if we're telling them about one line of trade from 10 years ago, because that's not really indicative of the current market for that business. That said, many of our competitors will still produce that because you're looking for anything you can. So, for our PACE analytic, we won't produce a score unless there's a certain number of providers that we're actually getting on that particular company, subject company. And we also need to have a certain number of trade lines to feel like we can really achieve like an 80% predictive floor.
So that's curious. Let's talk about the pricing model of the two platforms and, and how that works. It's SaaS. Is it monthly? Is it annual?
Yeah. So we are SaaS. They're both upfront annual fees. So, we get all of our cash up front, which is partially why we're able to finance our business so well. The way the CreditRiskMonitor site works is it is a user-based license model. So the initial license carries third-party licensing fees as well. We aggregate content from a variety of different providers, and then any incremental seat has a lower price point. For the supply chain monitor platform, we actually migrated to a larger user credential basis. So the first license actually allows up to 20 users on it. And the rationale being when we went through that development process with our current procurement teams, it's a much more distributed model where you've got a lot of category managers. There's typically a finance arm that's also involved in reviewing vendors. And so it's less of a kind of individually centralized role. And we needed there to be more people actually in the space where they could trade information more readily to get to better decision making. That one, we also do additional licenses at various different seat tiers. So, the first 20 are included. The next 20 block is at $700 a pop. The next is at $600, then down to $500 for 60 or above for enterprise pricing. So, we're pretty we're willing to negotiate basically on use cases. I would say it that way.
So if we're looking at the growth opportunity, looking at these two platforms, so what is it for, your legacy platform? What is it for the supply chain? I mean, there's obviously going to be some cross-selling here, upselling to all the customers that use your legacy product, right? But maybe you can give us an idea what that could look like. What are your current revenues right now? And, start putting that in perspective. I know you're not going to give any guidance, but give us an idea where you're going to be there, how that looks for you.
You're going to ask anyway.
Do you want to take that one? So our current revenues are just under 18. We're at 17.97. We don't really break out by products, so I won't go down that way and get myself into some hot water. But in general, Maj, to your point, I think the cross-selling and upselling opportunities on these platforms is clear. We currently have nearly 40% of the Fortune 1000 as clients, plus thousands of other customers worldwide. We've been into the credit space really with that CreditRiskMonitor platform. Most of these businesses also have procurement teams, right? I mean, it's hard to be a business of that size without having multiple departments. So we're, what I would classify as a approved vendor. So going through the contracting phase for getting into another department is a little bit easier. So that's really part of our go-to-market strategy, is finding out, obviously, clients that have been using us for the procurement space and upgrading them into this platform. That's a little bit cannibal, if you will, but we get better revenue rates off of the supply chain monitor platform than we do off of credit risk. So we think that's accretive. And then on top of that too, obviously, if we already have a connection into the credit space, it's now getting a direction to who we should speak to in the procurement space. And oftentimes our users are advocates. They've been with us for 20 years in many cases. So we tend to get some pretty good warm introductions into spaces. They already like our our platforms and our analytics. So we think there's a lot of opportunity there for upsell.
You said okay.
I just think there's two ways of looking at what we do. And one of them is, look at where we are today as an investment. It's the price of the stock, market cap minus the cash, and that's the EV. And we're selling it under one. We're a repetitive income business. We're subscription, super strong balance sheet. We have cash equal to 70% of sales. We have no debt. We're counter-cyclical. We're too counter-cyclical. And so, I mean, when I look at this stuff, it's return on investment, what the name of the game is. So the question is, what is our return on tangible net worth for the near-term investment thesis? Okay? Because what you got to know about a company depends upon the price that you're paying for it. If you're paying a half a cash per share or 10 cents on the dollar in cash, it's important to know that you don't have to do a ton of work on it. Conversely, on the longer time side of where we are as a company, at the end of the day, we have been selling a credit risk service into corporations for the last 20 years. Coincidentally, with that happening is the world over the last 20 years has not paid attention and doesn't really care about credit risk or interest risk. As a just broad generalization. And I feel comfortable saying that to you because as an older guy who was involved in this company when it was put together and designed, we never, ever anticipated negative interest rates as a concept. That's how weird this has been. Okay? You give somebody $1, they promise to give you back 95 cents. And as an investment guy, for me, as I was at one, that's like that couldn't possibly sell. Nobody's going to charge a fee to tell somebody that they should put their money into something to get 95 cents. At least in the old days when I was in the business. So this is a very, very different world. And so what happened is when you look at the only index of the marketplace that we've had been in, that's out there and it's public, it's Dun & Bradstreet owns 80 to 90% of the credit risk analysis market for B2B businesses. And they have a certain division in that company, which is credit analytical risk. And they break it out, or they did. And if you look at it, you'll see that you've basically been flat for 8 or 10 years or 15 years. This is a company that's been around since President Grant and President Lincoln worked for D&B. This is iconic. This is serious business. So what happens when these guys go flat for a 10-year period, it's because the marketplace that we're selling into, nobody at the corporate level thought there was any risk. By the way, nor did you guys. because everybody out there was buying governments at 1% and 2% and 0.5% of 1%. Junk bonds are like all over the place. Credit is 2.5 times GDP. This is not normal stuff, guys. And so that's the marketplace we had to sell into over the last 15 years. So we had to build this business basically in a depression for the product. So what we did is we built it. We pumped money back into the business all the time and developed it. And so that part of our business where we analyze the working capital of corporations, which all of you know is the jugular vein shortest tail on any company getting into trouble. You can forget all the other crap. Working capital, where the game is played as companies get into trouble. That's the deal. And trade or accounts receivable is the name of the game in working capital. We analyze that in real time. And we're really good at it. And it doesn't matter what we tell you, because we already got 30 to 40% of the Fortune 1000, and we got well over 1,000 other major corporations all over the world. These guys and gals see everything in risk, way more than you will ever. So we were coming to you as a company that was 20 years ago as a startup. Whether we got a good product is probably really much up in the air. Less so now. So that's the place where the immediacy is. Now, on the second part of our business, because we were going through this long depression for our product, we decided that we were going to take another part of the business, which was less countercyclical. Actually had a little cyclicality to it because basically risk went away. And so the purchasing side of the corporation, we already sold with our old system, our old software, 20 to 25% of our business is already coming from the purchasing side of that corporation. Much bigger spenders, much more complicated to sell, bigger departments. And so they started to buy our product because they were concerned with the economic viability of their suppliers. And interestingly enough, that's a big time risk. You have a factory and you're making cars, and the supplier of the starter can't put the products on the floor tomorrow. Your factory closes. All the employees, all the inventory, everything stops. No car sells without a starter. So the downside risk in purchasing is enormous compared to the working capital risk. So the staffs are bigger, they spend more money, they take longer to get into the game. So we already started to have business coming from there, and we said, my God, we're learning so much about this part of the business, and it has a little different flow than the credit risk side of the corporation. It had a little different kind of group of people. And so we started to put that together, and for the last 3 years, we designed a pretty exciting new product, reskinning all the data that we've been collecting. And we built in a product for the supply chain side of the business. And we're just getting into the marketplace now. So let me give you, it's a much bigger business than the credit side. Although I think the credit side is going to be humongous over the next 10 years. Why? Because for the last 20 years, it was in the toilet. Now, we're all capitalists, and we all realize that reversion to mean. Without reversion to mean, there's no capitalism. We can't have somebody making a return on investment that just keeps growing until it's 5,000% a year. We're going to get competitors. That's what capitalism has, reversion to mean. Same thing's true in risk. Same thing's true in risk. If you can borrow money, and you can borrow it at a rate of interest which is lower than what you expect to do with the money, you're going to borrow until they shoot you. There's no natural predator out there to stop the amount of debt that went out there. The government put their fingers, not our government, all governments. Everybody around the world got in on the game because it's contagious. You put your finger on this thing here, you lower the rate of interest for risk-free capital because the government's going to buy anything and everything. So every every schmata company in the world gets into the marketplace and starts to borrow money. We have 30% of the companies that we follow as zombies. Like, what's a zombie? They don't have enough income to pay the interest on their debt, much less amortize it. Who in God's name is lending them more money? That's weird, huh? So that's the excesses. And so that excess now in the supply chain is now where what happened was not only just the COVID, but this country starting, I guess in 2016, changed everything in the game. We started to have a very different view of what goes on in China. Everybody in the world has moved as much production as humanly possible over the last 50 years into China and Asia. Got 5 minutes to go on. And so there's a whole redeployment of supply chain because there's now tariffs, there's trade wars, there's embargoes. I just told you, if you don't have the starter on the car, the whole factory stops. You cannot have your whole supply chain in countries of the world anymore. So they have to redeploy. That's a huge job. Nobody's got staff to redeploy a whole movement over the last 50 years. That's what our supply chain product is saying. Look, guys, don't send your teams all over the world to look for new suppliers. First, check out whether they are risky, whether in fact they're going to be in business, whether in fact they're going to be able to put money into R&D and quality control. So you guys need to buy into us. It's a very different game than credit risk.
You know, Jerry, too, it's actually a growth. As the economy grows, too, it grows, too. So it becomes countercyclical, right?
Yeah, it's big and it's different. It's another income stream. That's what we're about. We're developing other income streams.
And I will say one thing, too, real quick, is that you talk about the zombie companies. We run the screen every month and every quarter at GeoInvesting, and there's about 1,300 companies still last quarter that lost $20 million for the quarter. It's ridiculous, and you know, access to capital for these companies is gonna dry up at some point. And you kind of predict that, right, to some degree.
You already see it in the startup spaces, right? I mean, it's just working its way into public markets.
Yeah.
The other thing I just want to add to what Jerry was saying here is it's also like we didn't necessarily come up with the strategy of going into supply chain and potentially into sales and marketing. I mean, these are the avenues that D&B currently sells into, right? So it's not something where we were trailblazing here. We know this data is viable in those different marketplaces. We haven't gone into sales and marketing yet because we wanted to get our supply chain product off. But I think that's the next place where we're going to go. I mean, part of what we did with Supply Chain Monitor was building the API background plumbing, essentially, to deliver our data up to a JavaScript object in the web. So it's a much more modern website approach and modular. So we believe that, you know, even though it took us about 3 years to design out Supply Chain Monitor, now that we've gotten that plumbing done, new products, new entries into various other verticals becomes a lot easier because it's just now calling the same objects. It's no longer having to go out and actually build the back end plumbing. So just leave you guys with that as well.
And you have $14 million in cash, no debt. I mean, I had a question from a bunch of people about what you're going to do with that $14 million in cash sitting there.
This is Jerry's favorite question because he always thinks it's the wrong question to be asking. I think, you know, the point I would put back is actually on this other slide, and it comes down to durability. The reason we have the cash here is because if you're a microcap investor getting in with us, you know it's an illiquid share, right? It's not trading very much. That cash is your back-end backstop. The other thing I would think about, too, is part of the reason we've been acquiring it and keeping it is we all believe that we're going into some sort of a downturn here. And as valuations for other businesses falls, that cash now becomes an avenue for us to do effective M&A. Right now, we just haven't been willing to overpay. I think most of the businesses that we've taken screens on and looked at, you know, they're trading at multiples that just don't make any sense to us, underlying assets.
And I like to say the wonderful thing about it means it means we have the cash and we haven't sent it out of the company. And it means as an investor, it's still there and we can use it. Once we use it, it's off the table for futures, guys. So as an old hedge fund manager, I paid up for lots of cash on the balance sheet as opposed to no cash on the balance sheet and a lot of debt. So it's just a question of how you're looking at the bowl, half filled, half not filled. And durability is the key to making money in small caps. And in order to have durability, you got to have countercyclicality, reoccurring flows of income, super strong balance sheet. I absolutely promise you, over the next 30 or 40 years, all of those things are critical for the survival and durability of companies. And if you can compound at X% for 30 or 40 years, you know what? You get to be very rich. And that's the deal. You got to be able to stay in. And you got to find companies that have those kind of characteristics. And recurring streams of income are the name of the game.
Are there any competition? Is there a fragmented market? Are there small competitors you could buy with that cash at some point, you think?
I think it gets more into like specialty data providers more so than actual direct competitors, right? I think it's about finding that new and interesting insights. I think we're done, but
all right, cool. Well, this has been a pleasure.
Anyway, if you are looking for us, our website's CreditRiskMonitor.com. I'm Mike Flum. This is Jerry Flum. I'm M Flum at Credit Risk Monitor. He's Jerry F. Just to make it confusing.
Thank you.